All right, day 7. We are making some incredible progress. Um, Day 7. One more day for this week, and then we have Friday off again. So far we've gone through candlesticks, discipline, and why it's important last week, and then trends, which I would say is pretty damn important. We went over change character and break structure, which I would also say is super important. Liquidity, most important, and now we're going into the building blocks. So as we're progressing along, hopefully you're seeing how some of these things are starting to formulate what would be a trading strategy, which is the whole point of this whole fucking thing. And by the end of next week, literally a week and 1 day from today, we'll be putting all of it together. And once we do that, that's where I recommend you guys probably look for your first trade if you haven't already taken a first trade using this strategy. So we are making incredible progress. Hopefully you guys are still watching these videos, even though I have seen the video or the viewer amount drop significantly. So don't think I don't see that. I do. So I know someone, at least one person, has already given up. Either way, today, day 7, one of my favorite, and what I would argue is by far, honestly, the second most important thing, building blocks. So, building blocks are what are what I would say make up the markets, right? So they are, liquidity is step 1. Step 2 is, a impulse move or some type of retracement, something within the trend sector. And then we would look for a pullback to a building block, that retracement into the building block to take a trade. Okay, so far we have found where point of interest are. Trends to trade with. Building blocks are now where to find entries. So right now we are going to go over fair value gaps, inverse fair value gaps, equilibrium, order blocks, and VI, volume imbalance. A lot of these you will probably already know the answer to and know what they are. And there's already a video on my YouTube channel publicly on some of this stuff. So we're going to just kind of rip through this, hopefully take 50 minutes, maybe an hour to knock this out. So let's get right into it. We're going to go this way down the list. We're going to go fair value gap first. Okay, fair value gaps are super duper easy to understand. And I already know what, wow, why is there dirt on my keyboard? Wow, okay. Fair value gaps are super easy to understand, and there's some questions behind them. So we're going to go to the 15-minute chart, and we're going to find the first fair value gap I see. Bam. That is a fair value gap. Okay. You might already know this, but in case you don't, it is, excuse me, a fair value gap has to have 3 candles to create it. Okay. In this example, we have this tiny candle, this big candle, and the third candle. These 3 candles, right? If you look though, the wick of the first one and the wick of the last one don't touch. In that range between where they're not touching, the imbalance or the gap is the fair value gap. Okay. Show another example. We see 1, 2, and 3 candles. This wick is not touching this wick. Ta-da. Fair value gap. Look at how we compare this already with the trend, the downtrend that we are seeing, and see where your entries want to be, right? It retraces to a building block, in this case, the fair value gap. Pretty interesting, okay? It's really not that complex. Let me show you a bullish fair value gap. All right, here's 1, 2, and 3 candles. This wick is not touching this wick, therefore, fair value gap. Okay. Hello, thank you. Here's another one. I'm just showing you examples. Don't matter if they hold or not. That's fair value gap. 1, 2, and 3, bam. Okay. Here's another one. 1, 2, 3. There's a gap, bam, fair value gap. So many examples. Let's find another bearish one. 1, 2, 3, bam, fair value gap. Let's show you an example of what's not a fair value gap. So look right here. take these 3 candles, take a look at this wick, and take a look at this wick. Do they overlap? Yes. Okay, they touch. Right? So therefore, there is no fair value gap there. That is not a fair value gap because there's no gap. Is this a fair value gap? Yes, because the wicks don't overlap. Okay, let's find another example of not a fair value gap. Bingo, right here, the bullish. This wick and that wick touch, therefore, not a fair value gap. Okay, let's find another example of not a fair value gap. Right here. Look at this wick, look at that. Not a fair value gap because the wicks overlap. Really it is not rocket science, okay? It's not a complex situation. Now, when I was first learning this, my first question was, 1, what time frame has the most important? That's going to be the higher time frames, typically, but also, what you're trading on. If you're trading on a 5-minute, then use a 5-minute fair value gap and a 1 minute and a 15-minute, right? If you're trading on the 1 minute, the daily is a little big. But let me find the example. Okay, here we go. Right here, we have 1 fair value gap. I'm going to have to zoom in for this. 2 fair value gap. And 3 fair value gap. This is not a good example because we just rip right through it, right? So let's act like, now that you guys already see that we just rip right through it, ignore that. Let's say we're drawing all of them out. Okay. You want the one typically higher. And this is where EQ, equilibrium, comes into effect. Okay. And how I use this is I have a Fibonacci tool with these settings. You can do 1, 0.5, or 0.5 and 1, period. 0.79 is for me and some other shit. But you literally just need these first 3. And ta-da, you'll have equilibrium. Okay, that's the tool. What I do is I like to measure out the move, the down leg. And you see EQ, equilibrium, is right there. Now we can delete this. I'm not interested in this fair value gap because it's not at a discount, okay? It's not a retracement, a far enough retracement for me to be interested in. Delete. Then I'm into for these 2. And what you then do is you're like, okay, I have 2, you watch, right? Because you're not entering just straight off of the fair value gap majority of the time, okay? In a perfect world, A plus setup, A plus execution, you're not entering just off of the touch of the fair value gap. Let's find another example. Here you go. This is actually the example I was looking for. Right here. This is a trade I did take. We have this right here. Is this the same exact? No, this is not. I'm an idiot. We have this. And we have this. Now look at how price kind of respected all of them to some degree. We're going to measure the move. Where's EQ? There's EQ. Right? It's the extension. These are not at discounts. Delete, delete. Bam. See how that works? Okay, so pairing, EQ is basically like an assistant. It's assistant to other building blocks, right? So EQ is really self-explanatory, but we'll get into that a little quicker and a little more in depth in a second. But when you see 3 fair value gaps, or 4 or 7 or however many, you want to narrow out which ones are not at a discount, right? Now, the other thing you can do is go to a higher time frame and think, okay, and this is where like I'm typically trading on a 5 and 1 minute intraday, and I see, wow, look at this. This is a 5-minute fair value gap. Can I break this down? Yeah, I can. I can go lower time frame. Let's look. Okay, instantly got rid of this one. Instantly, this is no longer relevant. Delete, right? I see there's 2. I have this one and this one. At this point, you can either draw them both out and watch, or go with the discounted one. See where they overlap, right? So look right here. Bam. Okay, then just draw this down into here and delete the 5 minute. Now you have what I would say is a pretty damn decent fair value gap. You see how that happened? You can break down the time frame. So let's find another example of this real quick. What are those red lines for? I don't know. Let's go 1 hour. Let's find a nice fair value gap. Where do we hold a fair value gap at? Okay, here we go. Let's go 4 hour actually. This will be clean, I think. Damn it, there's no fair value gap there, is there? No. That sucks. Alright, we're gonna have to do 1 hour. This is a fair value gap that we just smashed through, so never mind. That's not a good example. Let me find a good example. Bingo, right here. Fair value gap, right? See it on the 1 hour, and just to make my life a little easier, here, we can see we held it. How did you know that was fair value gap? There's 1, 2, and 3, and 4. EQ. Well, there you go. Right? It instantly got rid of this one, and this one. So there's the process of elimination. We drop time frame. Let's see if we can narrow this down. All right, so we got nothing on the 15 that would be worth editing, right? You're looking for changes. Nothing really on the 5 minute, and at this point, I'm not going to a 1 minute, right? If we're going from a 1 hour to a 1 minute, you're doing a little nuts. Okay, so that's not the best example, but you can drop time frames like that. Let's see if we can find another one. Let's see, there's probably a bullish one somewhere, or a bearish one. I'm sorry. Here we go. Select bar. Bam. And yes, this is not EQ, I don't think. Highly doubt. But just to show you an example. Fair value gap, 1 hour. Let's go 15 minute. Does it narrow it down? Yes. Am I tweaking this? Yes. Bam. To bam. Okay. But there's another one, Sam. There's one up here. Yeah. Mark them both out. Mark them both out and see which one gets respected. Watch real time. Okay. Let's go 5 minutes. Let's see if there's even a change in here. There's not. Except we have now this tiny 5 minute fair value gap right there. Wow, that actually worked out perfect. Look at that. 5 minute fair value gap. Respected it perfectly and drops off. And that, we go back to the 1 hour time frame we started on. Look at how much risk you just de-risked. So instead of risking this entire 80 points, which is quite a bit, you are now only risking 12 points. That's the power of dropping time frames. You can narrow down your risk, and instead of risking, 100 points, maybe we can risk 10, 20 points. And that's the whole point of dropping time frames. Okay. So fair value gaps, pretty self-explanatory. Pair them with EQ, they go really well together. And then drop time frames to narrow things down. Okay. Again, fair value gaps you probably want to keep in mind when you're looking at trends and stuff, and break a structure, right? So you have break a structure, retracement. That retracement sometimes you will find goes into fair value gaps. Okay. So if we break the notepad out, take our notes real quick. Building blocks. Make this look nice. Bam. FVGs are best paired with EQ, which I can just put in parentheses, 50% retracement. Hello, on fib. Okay. FVGs can be narrowed down by timeframes to reduce risk. FVGs, I'm just going to add this in case you don't know, are made up of 3 candles when the first and last candle wicks do not touch. Okay. Creating gap. Watch for FVGs when trend makes retracement. Okay. Pretty cool. All right. Now let's go into inverse fair value gaps. This is where things get a little more interesting. So let's probably see if I can find one on the 1 minute. So look right here. And this is actually a very interesting example, and it kind of pissed me off this morning, transparently. So here we go. Market open. We have fair value gap, right? You notice how we ripped right through it? We inverted the fair value gap. Okay. Came up at this point. I was like, oh, wow, look, inversion plus a creation of a new one. Huh. Could we retrace into the connecting parts, aka that entire fair value gap, and see a hold? Yes. Fascinating. Now, what ended up happening is we turned around and inverted the inverted fair value gap, and I made a joke. I was like, it's an inversion of an inversion fair value gap, right? Double eyes. Came down. We then invert this fair value gap and close and truly get a break and change of character, in my opinion. We break of structure here, which, I mean, technically break of structure would be there. Break of structure, well, here. Bam. Look what gets created. Fair value gap. Look at how price came off of that and respected it. Bam. Okay. So an inverse fair value gap is typically used for like a breakout trade. Right, so let me see if I can find another example from today. A decent one. Here you go. Let's go 5 minute actually. Let's look overall, not just today. And now these things are typically best paired with other influences. So like if we're hypothetically, let's say we're looking for some type of short up here, whether it be an order block or whatever, which I think it is technically, and we see this is a fair value gap that got respected already once. Right? Sorry, I was looking at my phone. We can see that we wicked off of it, bounced higher. We come through it and close below it. Okay. If you have other confluences paired with this to be a short, and you see that, sometimes you can jump in to catch momentum because it means there's no buyers right there potentially to hold us up. Sellers are taking control. Right. Here's another option. Right. And now a inverse fair value gap still has to be a decent fair value gap. So we have 1, 2, and 3. Let's not forget about EQ. Let's not forget about what makes it a real fair value gap. Here you go. So that's a real fair value gap, and we didn't invert it. Okay. So yes, you can technically say, oh, well, we inverted this one. That's, in my opinion, not a really A+ fair value gap. So you still want an A+ fair value gap. Oh, I'm on a 1 minute chart too. Here you go. This is a good example. This is a fair value gap that I would say is A+. Why? The extension part of this trend, EQ, it's an EQ, right? Look at how price came down, smashed through it. We close on the other side of it. We inverted the fair value gap. And then look roughly, look at the, ignore the wicks for a second, because the wicks don't invalidate it. It's only if the body closes. Look at how price gets respected right there. Drops lower, comes back up, refuel, move to the downside, plummets, right? That's an example of an invert fair value gap. Now, are these as high quality or, you know, as important as regular fair value gaps? No, in my opinion, they're not. It's typically like paired with, you know, some type of other confluence, as I've already said. So like, let's say you're kind of looking for a short, you're looking for an entry. Okay, bam, inversion, right? And there's probably even a better one on the lower time frame. So here you go. See this? Fair value gap. We invert it. Bam. Right? You look for retracement, whatnot. And then maybe you're looking for, okay, maybe this is a trend change, right? Maybe we're looking for whatever. I want this to hold for us to go higher. Oh, we don't hold it? Cool. Bam. Right? Paired with other confluences. I cannot stress that enough. But they're not like the most important thing in the world. Here you go. See this fair value gap? Look how price holds it for a little while. Breaks through it. We rip to the moon and take out opposing liquidity. Bam. Right? So it's used as like, okay, this is a key breakaway, key breakout spot, potentially. Right? But you don't want to just trade that by itself. So let's go notes. IFVGs are when fair value gaps get disrespected. IFVGs are best paired with other confluences. Ignore the spelling. IFVGs are typically used as breakout spots, and then put like AKA momentum, which also ignore spelling. You get the point. I'm not even gonna fuck with it. IFVGs are, in my opinion, not as important as FVGs. IFVGs still need to be valid FVGs. Okay, so just as we said, equilibrium, what makes a good fair value gap makes a good inverse fair value gap. Okay, can't be like, oh well, it's right up here. Would you take a long off of it? No. Okay, so then if we smash through it, it's probably not going to be an A plus fucking inverse fair value gap. Crazy. An A plus fair value gap that gets inverted is probably an A plus inversion of a fair value gap, right? Hopefully that makes a little bit of sense. I don't think it's rocket science. Yeah, so fair value gaps get disrespected. They're best paired with other confluences. They're used as like breakout spots or breakaway zones. They're not as important as fair value gaps, and they still need to be valid fair value gaps. Okay. Hopefully that makes some sense. I would say like last resort for entry. Okay. Just another confluence. Someone in the call, does that make some sense? Or do you want me to dive a little deeper in that? Because I feel like that's very, very like quick. Dive deeper into it? Or doesn't it make sense? Which one? Alexa, skip. ABC, which one? Dive deeper or make sense? Makes sense. Okay, cool. All right, moving on. Equilibrium, we've already explained, but I'll do a little more. Okay, so right here. Actually, no, we're going to go today. And we're going to go to the low time frame. And this works on all time frames, guys, but it works really well. So, as we know, a trend is made up of two parts. Extension, retracement. Extension, retracement. Okay? Pretty fucking easy to understand. So let's find an extension move of, let's go 5 minutes. The trend's very, very clear over 5 minutes. Okay, where's the extension? Bam. Retracement. Extension. Retracement. Extension. Right? And slowly starting to dissipate because of end of day and lunchbox. So let's look at this. There's high to low. extension. Look at EQ, right? So it's typically just a good pullback spot to take note of. Once again, this by itself is like just eating mustard by itself, guys. Mustard by itself. If you like that, I don't know who you are. I don't know why you got some weird taste buds. Long story short. Right? Let's go to this 1 minute. Show the same trade I took. As I mentioned, I was sitting here looking for a retracement into a fair value gap, and I saw this one, and I was like, dude, I'm gonna miss this. For a couple minutes, I was like, I'm going to miss that. But I was being greedy. Well, I wouldn't call it greedy. There's the extension. And I was like, but we're not at EQ. I cannot take a short until we're in a discount. And sometimes I do bend this rule. I'm not going to lie to you guys. Okay, sometimes I will bend the rule. But the best A+ trades that I can remember come from me seeing it and going, I'm going to wait. I'm going to wait. I want the discount. Okay, I want to be greedy. I want my discount. I want to save a buck. And sure enough, bam, right? So EQ is something just to take note of, right? Let's look for another example. Let's go right here. Where's the extension on this 1 minute? Bam, right? Because you have extension, retracement, etc. So let's take this part. And we're screw off with the fair value gap because I know you guys can see it. Look at how price kind of respects roughly that area. Okay. Let's go find something on the 15 minute. Decent retracement of an uptrend. We'll go 1 hour because I'm sure there's a trend. It's really not been trending for a while. Here we go. Clear uptrend. Start, retracement, etc. Look at this leg. Look at EQ. And if you go watch the video I have on my YouTube channel, you will see a A+ example of EQ that I realized was an A+ setup in real time. But you can see how we respected that. Let's delete this. Let's look at this first extension. I don't know exactly where the pivot point was, so we'll take the low. Look at how we kind of respect roughly that area. Okay. Let's go find a downtrend example. Bingo, right here. Take extension. That's pretty close to being A+. And look at how we came right to it. The fair value gap, right? So EQ, it's mustard. It's paired with other shit. Okay. So it's just an assistant to other building blocks. Okay, so pull the notepad out. Let's go here. EQ, which is always going to be my abbreviation for equilibrium, is best paired with other building blocks. It's mustard. EQ is measured. I know how to spell measured, bro. I feel like that's not spelled right. I'm not even gonna worry about it. EQ is measured. Don't even correct me, ABC. I already see you typing over there. I don't want to hear that there's an A in there somewhere. I'm not thinking about it. It's measured from. I'm not doing that because by the time it types it out, that's just too much effort to care about spelling. Do you understand what it means? Yes or no? If you can correct my spelling, then you can spell it properly. That's what matters. That's my rule. If you can correct my grammar, you understood me well enough to know how to correct me. So you didn't need to. EQ is measured from extension. I also know how to spell that word, and that still looks wrong. Good Lord, bro. My brain. Extension. I give up. I give up on spelling today, guys. Okay, look, you can ask me any multiplication. You can ask me basically any math problem, and I can fucking solve it in my head. Spelling, not me. It's measured from extension, start to finish of a trend. Hopefully that makes some sense, like, overall, though. Ignore the spelling, right? So, let me see. I'm actually going to rewrite that. EQ is measured, I spelled it even worse, from extension, start to finish. I know it's literally exactly what I just wrote. I don't really care. I think that's just the, yeah, of a trend. Yeah, I think that'll be fine. EQ is also referred to as discount or premium. EQ is 50% retracement. Yeah, I think that's really all you need to know about it. It's best paired with other building blocks. Okay. Cool deal. What's next? Order blocks. This one is where it gets a little confusing. And if you don't understand liquidity, then you're not going to understand this one. So step one, find a liquidity sweep. Let's use, wow, this is actually going to be a fucking A+ setup too. I already know it. I can already tell. Do this. And we'll use 1 hour liquidity. Is that a liquidity sweep? Yes. Great. Drop time frame. And it's actually not going to be an A+ setup because it is freaking CPI news. All right, back to the drawing board. Find another example. I want a true liquidity sweep. I don't want a liquidity grab, even though they're the same thing on the same time frame. I see them all the time, and then I just like when I try to find one, I can't see it. I've probably gone through like 7 already. Why can I? All right, we're going fucking 5 minute, bro. And this is a little more complex, and if you don't understand what I'm about to explain, there is another YouTube video on my channel that you can watch that has, I would say, a really decent example of it. I'm just trying to find one close enough. Like this low-key could be a good one, but I don't really want to use it. Which sounds crazy, but okay. This is a liquidity grab, so bear with me. We're going 15 minutes, so it's like it's a liquidity grab. Liquidity grab. Or you could even say like maybe a sweep right there, depending on time frame. We're on the 5 minute already. Okay. Let's play it out a little bit. Okay. So where is the leg of the trend that swept liquidity? This. Okay. Why did I just delete it? What the fuck? My brain is cooked. Ta-da. Okay. So we sweep liquidity. This is the leg that breaks the liquidity, aka the sweep. I'm going to change this to red to signify a seller's order block. And you can even go lower, I think. Let's see. Yeah, I can. So I would say here we swept this liquidity, sweep of a sweep of a sweep. We can change this to here, right? You see why this is leg, retracement, leg, retracement, leg, retracement. It's a little rough up here. We start to see that we're running out of buyers. There's actually a perfect example of it hitting an OB plus fair value gap plus equilibrium. Like this right here, I'm not even gonna lie to you guys. Here you go. You want to see them all to work together? There's fair value gap. If only there was a inverse fair value gap here too, you would really see it all. With EQ, you could either take it from the high or here. Let's say we take it from the high. It should be fine. Yep. EQ. Into order block. Into fair value gap. Take out. Bam. Down to liquidity. And there's probably even more liquidity down here. Yeah. That's a really, really good trade right there. Yeah, look, we even go and take out Asia liquidity too on that leg. That's borderline A+. Like, I'm not going to lie to you guys. This is borderline A+. Liquidity sweep, impulse move, retracement to order block, right? Because it's the leg that swept liquidity. This leg, retracement, extension leg. Move out of it, back into the order block, right? And I think we I could be wrong, but I think we hit it again. Maybe. Yeah. So look, we hit it again. We get some sellers out of it. Okay. And then just out of curiosity, there we go. Nowhere I care. Right. So that's actually this right here. There you go. That's A plus. All jokes aside. I know we're moving a little further ahead. Let's see if I can find another example real quick. Let's go 15 minutes so I can drop all time frames. We got to find a liquidity sweep. Liquidity sweep is important. And liquidity sweep is the first step to OB. There is one right there, which I could use probably. I want to find a bullish one. Grab. Is that a sweep? Nope. Damn you. Here we go. Select bar. Bam. Liquidity sweep. Bing. Okay. As of right now, where's the leg that swept liquidity? It's all of this. All of this right here. Okay. But just as we can do with fair value gaps and other stuff, you can narrow it down. So we drop time frame. Where's the leg that swept it? Okay, cool. What time frame is this? 5 minute? Could we go on a 1 minute? I'm actually curious. We can. I don't know if this is going to work. Right here, this one kind of works actually. Right. You can see we start to hold it. If we go down. Okay. Right, so you can see you get a little move out of it. It's a retracement tool. Also, one of the least important. Technically, I would count this as the order block right here because this is the leg that swept the liquidity. Go to the 5 minute just so it speeds everything up. Bam. Let's see if we get a retracement into it. Not quite. Was it the 5 minute one though? Or the, wait, the 1 minute? Full 1 minute? Or 15 minute? Can you guys tell that my brain is cooked for the day? Not really the best example. But technically, 5 minute liquidity order block would be this. And sure enough, we respect it. We bounce out of it, right? Again, sometimes best paired with other building blocks. That's what the universal theme here is. Ooh, this is a liquidity sweep. Cool deal. This one could be good. What's that? Well, I would be after 3,300. What is it? How much I just moved? Or what are you talking about? I don't know what you're talking about. Okay. Here's this is an example. Select bar. Where's a leg that sweeps liquidity? I look, you can't see it on the 5 minute. Technically, on the 5 minute, it's all of this. Just gonna run with the 5 minute for now. I wish I could make this faster. We're gonna drag this all the way out. Wait for price to retrace into or B, which also sits with a fair value gap, which is also paired with equilibrium. So not bad. See if we actually get a full touch. There we go, full touch. Let's see if price respects it. There's another liquidity sweep and another liquidity sweep. Is there an order? Do we already do this? I feel like we did. Right. So, what is this? Oh, this is 2 in the morning. Damn it. Fucking London. I hate overnight sessions, and you'll come to learn that. There's one. Did we sweep this? Nope. Bang. Here's another bearish one, probably. 15 minute. Find the leg that swept all of this liquidity. Technically, it's like literally all of this on the 5 minute. Can we go to the 1 minute? I don't know. Leg that swept it would be on the 1 minute this. Just reduce your risk to like here. Kind of rough. We hit you, order block comes out of it. Okay. Order blocks I use the least, transparently. And if you Google it, you'll hear people say order blocks are multiple different things, right? Everybody has their own take on it. Some people will say an order block is the wick of the candle at the low, right? That you only get one order block per trend. I don't necessarily agree with that, but I can see why people might say that. So like that wick right there is order block. And then like this wick is order block, right? So that if you retest into the wick, then you get it. So like, let's find an example of that. Because knowing both is like still important for OB. And like I said, there's a good example on somewhere. So right here, here's a wick. We retest into it, you take off. Here's a wick. Right. Take off into it. Yeah. Which, sweep liquidity. We're on the 1 minute, so that's not even away. God, this is literally just today in general. Which, funny enough, look at the price action. You ready? I'll show you guys something cool. What is this in Q? Ah, we got a SPY. That was pretty clear. Oh, on the higher time frame. Ah, so the whole move is this. But that's like different versions of order blocks, right? It's basically supply and demand, which we'll get into either later this week or maybe Monday it is. I don't remember. So I don't really want to go more into it because I don't use it a whole lot. OB is when liquidity gets swept bottom of the move, bottom / top of move. I'm gonna say up sweep. Okay. Overall, that's universal no matter how you draw it out. Can be the entire wick of sweep or the entire leg of sweep. Which low key, like, if you do the entire leg, then you get the wick. It's up to you. Least important, which is crazy to say, of building blocks. Best paired with as many BBs, building blocks, as possible. Low key, and yeah, I would low key say like inverse fair value gaps are probably better than order blocks in my book. Like I said, there's a really good example of it like working, like me realizing it real time on YouTube already. So if you want further explanation, there's no way I spelled that wrong. Go watch other BB video on YouTube. Okay, I think that's everything for that. What's next? Volume imbalance? Oh, we're making good time here. Volume imbalance. This one you already all know. We're going to use QQQ for an example off the rip, just to show you guys what it is and why I say you already know what it is. See how we gap down? Guess what that is? Volume imbalance. Volume imbalance is simply gaps. It's really not that complex. Look at this. See how we gapped up, start of new week? I think is what that was. Yep. There's another volume imbalance, another one. There's one. It's all QQQ, so they're going to be more drastical. AKA, everybody knows you look for gap fills. Okay, gap fills are important. If we go back to NQ, you're going to see a lot less of them, transparently. Okay, NQ does not like to gap. It's typically at start of week, and you want to retrace into it as a hold. It's basically used as an extra target, an extra confluence of like, hey, you know, we might be targeting gap fill. We might be targeting the volume imbalance. Another really good example of this, which I'll show you in just 60 seconds because I want to show you this one. Right. Really good example of how these can be used is if we go to gold or silver for that matter. Go to 1 minute. You will see gaps all around these prices. We fill it. Right here, and we fill it. So this right here is not volume imbalance. Because you see how this candle closes? We open here, we fill the imbalance on that wick, and then move lower. Okay, so it has to be 100% a gap. Like right here, that's not volume imbalance because that wick filled it. This is volume imbalance because we closed here and opened there. You see the gap between the open and close of that candle? Volume imbalance. Right here, volume imbalance. Right here, volume imbalance. Okay, gold is fucking filled with them. Not volume imbalance. Not volume imbalance. Volume imbalance. Bam. Okay, volume imbalance. Bam. So it's typically used as like a target confluence. These are not super duper relevant just because like NQ doesn't print a whole lot of them. And that's where if you do see NQ print a volume imbalance, especially on an opening week gap. So when weeks roll over, that's where it becomes important. So right here, Friday to Monday. Look at how we filled it. Okay. Let's go find another one. Which, I mean, there's one down here. So look right here. This should be Friday to Monday. Candle closed here. Candle opened there. We never filled. Technically. So there's volume imbalance from that wick to right there. Bam. Okay. It needs to touch the body unlike a fair value gap where it's just the wicks. Okay. Where's that gap is that the gap we're trying to fill? It is the gap we're trying to fill. I know there's one back in June. There's one. We already went over that. Let's find another. There's one right here. Probably Friday as well. Yep. You see how they're all opening week? Okay. So they typically get filled, like let's say opening week happens. They get filled typically within that first Asia session, first London session. If they don't, we can use it as a confluence. So like right here. Right. Came down into it, popped out of it. I wish there's, yeah, here's a big one. Yeah, Friday to Monday. We leave it straight behind and we can use that as like, hey, we should probably target gap fill. If we start getting down into it, you know, you take a trade, let's say like maybe somehow you're short right around here, you can target gap fill. And once you get into it, the volume imbalance between it will really start to show. So if we go to QQQ, find a gap. Where's that big ass gap that we're trying to fill? Right there. Put it on replay mode. Show you exactly why it's called volume imbalance. Indicator, volume. Let's do visible volume range. Change this. This is not something like you guys need to have as an indicator on it. Let's do 100 points, 100 bars. Can I like perfectly? There we go. That should be great. So look, you see the gap, the drop down. Let me change that so it gets rid of that. Right there. So look in between here and here. Okay. It's where volume was basically 0. So gap fill, in my opinion, would be about 614.5, 0.4, 0.3-ish, right? And if I replay this really quickly, we're in it, and look at that, we're starting to fill it. Okay. Volume profile will show the volume imbalance because this shows the imbalance in price. That's why, like, if we go to, let's say, Meta, who's been super weak and having some crazy moves with this on, you can see the straight down moves create lack of volume. Now, it's not an imbalance because we still have volume in there. Versus if we go, let's see if SPY has a gap. Right here, invisible. you can see the gap in the volume imbalance. Let's see if I can add this right. This is visible, so right there you can see the gap, bing, 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 right in between here and here, which if we literally just draw it with a box off the indicator and drag to the left, there's your volume imbalance. Where could we be targeting? Potentially that. So you can call them gaps, you can call it volume imbalance. I don't really care what you call it, as long as you know what it is. VI, volume imbalance. Dude, I'm just leave it spelled over. Volume imbalance, aka, or volume imbalance is gaps. Very common on ETFs and equities. Not super common on futures, except for gold. VI is used as a target rather than an entry. Important to take note of if new, how do I write this? New week gap is formed on futures. Right, so Friday close to Sunday night, or aka Asia open. Right, if we get a gap, then it's going to be important. I feel like I don't even have to write that out, because if you're reading the notes and taking notes, then you heard me say it. So take note of that if you want. Also, not super important. Okay. Just use it as a target. All right, what's next? Nothing. Cool. Wow, it's exactly fucking 50 minutes. That's crazy. I could end this right now and just be done. So cool. If you got it, you can get the hell out of here. So I'm gonna recap everything real quickly one more time. If you don't need that, you can leave. Let's go NQ, because I like NQ. It's my baby. Fair value gap. It is a gap between 3 candles, wicks not touching. Candle A for 1, candle 2, candle 3. Are they touching? No. That is a fair value gap. Okay. Fair value gaps are used as retracement tools, basically looking for it to pull back into it. Very similar to equilibrium. Equilibrium is where you will find a discount, right? If you want to short this move, shorting down here, you're not shorting at a discount. Technically, you're shorting at a premium. Okay. You want it to be on sale, right? You want it to be on sale. You can also think about this logically, like if we go to the weekly and we're like, oh, cool, I really want to buy this market, but up here we're a little high, we're creating all-time highs. Well, where would be a discount? Discount would be down there. That's a decent spot to buy, right? Kind of get the math here. Let's go monthly. I want to see something real quick. There's an extension. I'm just going to call this an extension. Can I take this whole move as an, yeah, technically this is a whole move extension. Wow, look at this. EQ, it's discounted. Look at where people, wow, it's literally like exactly on EQ. That's actually pretty nuts. I'm not gonna lie to you. That's pretty freaking nuts. Lows to highs, it bounces EQ. Are you dead at? There you go. There's your example of EQ. I don't need to say anything else. Cool. Inverse fair value gaps. Used as breakaway spots, okay? This is momentum. So if you are, which low-key I think was yesterday's example, was probably the best one. Wednesday, where's Tuesday? Tuesday, bam. Opening bell would be right here. Paired with a bunch of other confluences, I was interested in shorting this already if X happened. We come down to this fair value gap, and instead of holding it, we invert it. Ta-da, it shorts, okay? Inverse fair value gaps still have to be good fair value gaps, but are best paired with other stuff, okay? But can be used as breakaway spots. Momentum is no longer up. Buyers are taking control. You typically will see a BOS, or you'll typically see a change of character and an inverse fair value gap. Okay? Typically, you will see a change of structure and an inverse fair value gap together. Okay. Order blocks. Order blocks are supply and demand, basically, and it's at the highs. So right here, we swept liquidity. Bam. Right up here, order block of sellers. Okay. The logic behind this is you have people trying to fill their shorts. Okay. There's pending orders that are unfilled orders up here. When price retraces back into it, they're filling the sell orders, so it pushes it down, right? And down here, we'll just use like this example. Same kind of thing, right? And when we smash through it, it's basically a breaker block, okay? But you might as well just use an inverse fair value gap at that point. And that's why I didn't tell you about those. Here you go. There's a bullish one. Left behind pending orders. Every time we tapped into it, fill, 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 push. Buyers and sellers. Okay, this is where trench warfare analogy will come into place, and you'll understand more of this with supply and demand. Demand, supply. Left orders, left orders. We ping pong between until sellers or buyers win the boxing match. Pretty self-explanatory. Volume imbalance is simply just gaps in volume and gaps on everything pretty much. Okay. Now, when you're looking at SPY and QQQ, guys, on the daily, you're going to see a hell of a lot more volume imbalance. And that's because on the daily time frame, you're not going to see the extended hours. Extended hours are going to be relevant to finding volume imbalance. So 4 hours you're really going to want to use. If they show up on both time frames, then good. Volume imbalance. Didn't touch, bam. Okay, this is no different than saying, oh, wow, there's a gap on SPY. What if we fill it, right? And that's exactly what happened right here. Volume imbalance. We came up and filled the gap. Right here, we left behind a gap. What do you think happened? We filled the gap. Okay, you'll hear a lot of people say, I wonder if we're going to fill the gap. That's filling volume imbalance. Pretty self-explanatory. So, that is basically everything. That's the building blocks, okay? That's all you need to know as far as, in my opinion. There's plenty more out there. You got breaker blocks. You got fucking, I don't even know what else. You'll see people go on 3-minute time frames, 2-minute time frames to find an inverse fair value gap. They'll do all this crazy stuff. I don't think you need it. If you want to go down that rabbit hole, you can. It's just a waste of time, in my opinion, and unnecessary information. If you want to extend your learning curve, go nuts. Okay, there they are. Here are the notes again if you want to take them, which I highly recommend. 1, 2, 3, 4, 5 different topics. If I have to rate them, fair value gaps are number 1. EQ isn't even on the list because it pairs with everything. Okay, EQ is an assistant. It is a seasoning. It is a condiment. It is literally just, don't forget EQ and go ahead and create that Fibonacci tool. Okay, volume imbalances targets. Order blocks are little least important for entries, but something to take note of because they do have an effect, and it's supply and demand basically. Inverse fair value gaps are pretty important, but definitely last resort. Pairing as many of these together as possible will give you the highest rated trade. Okay, think about this. If you know how to play poker, you'll get this. If you don't know how to play poker, well, you probably want to look it up. It's pretty fun. Having one fair value gap with nothing else. That's your one pair, okay? If the people are betting really heavy into that table and you have one pair, how much risk are you willing to put on that hand before you fold, okay? If you pair 2, now you got a 2 pair. 3, now you got 3 of a kind, or maybe a boat or something, right? A full house. You can start to up your rating of your entry and your trade idea based on how many building blocks you're able to stack, okay? 1 Lego by itself ain't shit. 2 Legos together, you could build something with 2 Legos, okay? It ain't gonna be pretty, but you could. It's only when you have 100 Legos together that you're able to form something that's pretty fucking cool. The more Lego pieces it has, the cooler the build. Pretty easy to understand in my opinion. Okay? Same way here. Now, let me see what we're getting into so I don't jump ahead. SMT divergences. That's tomorrow. That's going to be a really quick video. Like that video we could probably get done in like 5 seconds. Not really. I almost am considering putting it into today. I'll let you guys vote. ABC, Dom, do you guys want to put SMT divergences in today and just have an early week? And there's already a YouTube video out there on it too. And the vote is, I'm down to do tomorrow. ABC, don't change your answer. Wow, it's a very long drum roll. We'll do SMTs tomorrow. There's already a YouTube video on it, so if you want to just get it done with today, there's one. Literally just the indifference between liquidity sweeps. Long story short. All right. Well, that's it for building blocks. Okay. That is it for building blocks. Yeah. Wow. Look, SMT. Crazy. I see like 3 SMTs. Funny. Is there a sequence that we have to mine for building blocks? No. Probably not. In the sense that you're asking. There it is. Yep. Yep. And that's what will come together with putting it all together. So I will give you guys a sneak peek of that. So there's a couple other things we want to get into. But so far, how to set up an A+ trade is, we'll draw that out because I don't really feel like going and finding one. Let's say we got some, give me that, come on. Bop. You know, we're forming some liquidity. We got a little this, a little that. Bam. We come down. Okay, I'll just come down at equal lows. Liquidity sweep, impulse move, retracement, target liquidity. Okay, so right here in this example, we have liquidity sweep. I'm low-key going to change this so that I can include change of character as well. We have change of character, step 1, impulse move out of the liquidity sweep, a building block of some type to be in this area. Okay, whether it be an inverted fair value gap that you want to short into or take, you know, cool, you can do that, or wait for the retracement. Okay, that retracement in this red spot is the building block that you want to short out of. Now, we're really putting it all together here, so if you're still here, you got a little sneak peek. As we know, based on time frame, so what I'm going to do, draw an arrow like this. That's a really bad arrow. So that, yeah. This uptrend on a low time frame would look something like this. Right, a retracement on a high time frame is a low time frame uptrend. You guys remember that? That should be in your notes. It is in your notes because I fuck it right here. Look, high uptrend, yada yada yada, trend, da 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 da, depending on time frame. Wait for 2 step, identifying trend, da 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 da, break structure. Did we really never go over that? There's no fucking way. I know for a fact I said that. What? Did we never go over that? No, there's no way. All right, I know for a fact in the video it is said that a low time frame or a high time frame retracement is a low time frame uptrend, right? So if this is a close up, like a zoomed in, let's say this 5 minute, this is a 1 minute, when you see into the building block, we'll draw out, say this is the building block. What you are looking for to enter is a change of character on that load time frame, right? Because what if this just continues to chop or, you know, have a low time frame uptrend all the way back to the highs? Well, then we're fucked. So you're waiting for the low time frame to change character. And on the 1 minute, you don't have to wait for, oh, what about a retracement on that? And really confirm it. Guys, half the time when you're on a 1 minute, it's a fucking wick. It is literally like it wicks up and comes down. So yeah, I mean, if you want to wait for the wick, by all means, but half the time, don't even guarantee yourself. And you could rush into all that shit, because what happens if you go to the 30-second or 15-minute or 15-second? Then there's like an uptrend in that. Then you gotta wait for a break structure. What about the 1 second? Then you got nanoseconds. Don't do this, okay? Don't. Welcome to taking risk of trading. Right? Even if it's just a wick, you're looking for the change of character of that trend, and you want to like basically kind of jump into it, and you short with your stop either right here above where the uptrend, the pivot point, or risk the entire fair value or the building block, right? In this instant, you know, I would probably risk here if I have, you know, a high provenance or high confluence trade. I don't know what the hell I just said. So what that would look like is like an entry here, your risk being on top of that, and your target being the opposing liquidity. Now, all of this is low resistance. Where would your target be? It would be here. Now, what happens if we have some volume imbalance in here? What do? Say this is volume imbalance. Hypothetically. Oh, wrong one. Say volume imbalance. That's a box. God damn. That's volume imbalance, and yeah, you can target the gap fill there too. But you absolutely should be doing something to your trade, managing it when you do there. Right, so that's putting it all together. The liquidity sweep, the trend, liquidity sweep, change of structure. Look for a retracement to change the structure. The second confirmation, step 2 confirmation. Wait for the low time frame, a change of character from the retracement. The uptrend turns into a downtrend on the 1 minute versus the 5 minute. Bam, you enter short. You then go back to the 5 minutes and set your targets. Right, so here you go. Watch this. 15-minute. This is, yeah. 14, that's 2. Wow, holy moly of Christ. Oh, wait, what? We'll use this one, because I already have everything marked up. Let's mark out liquidity, aka our targets. Bam, bam. All of this low resistance liquidity. Okay. We then can drop time frame. Now, this technically didn't sweep liquidity, which was one of the things. Bam. Look, we go to 5 minute. 5 minute retracement. There's a 1 minute uptrend. Well, unless this is what I think it is. Yup, it is. Comes into it. Right. You could also do it here, which all of that got taken out already. There's that 5 minute one that I shorted, that I actually did execute on. Change of structure, right? Liquidity sweep coming from an uptrend into a downtrend. We have a inverse fair value gap. We have liquidity sweep of these highs. We have an impulse move out of it. Creation of a fair value gap with a trend. Replay mode, so I don't have to go find it. Drop time frame. There's your low time frame uptrend, high time frame retracement. Wait for a break of structure. You would be short. Say perfect entry right there. Your stop could be above those highs. And then guess what you do? Let's draw this out so I don't have to like really mess with it. Go back to that 5 minute. Go back to, we'll go back to 15 minute. Where was our high time frame targets? Volume imbalance. There's one. Roughly down in this range. Just gonna leave it like that. All this low resistance liquidity. Low. Can I, you know what? Fuck it. Just right around there. We come in, let's drag it this way so I don't screw it up. So you're risking 30 points, like $500, to potentially make, all the way down to volume imbalance, 200 points. Look what happens. And we end up taking all of it out and we're still chilling. But you'd be up 125 points right now off of risking 30. Pretty cool on how when you build it together, it all starts to come together. Okay, that's it. I'm ending the recording here. Hopefully it makes some sense. If you have questions, DM me, tag me. I don't care. I'll help you out no matter what. So, yippee. If you want more explanation, there's already a public YouTube video out there on building blocks. There's some better examples in there. Feel free to go watch that if you want. You can skip around in that video, watch it on 2x speed, whatever. But there's, if you want a better one on like order blocks and stuff like that, highly recommend that video. Peace out.